Okay, we want to, in our last session, we stopped with contributions. And so I want to pick back up with contributions and start at that point as we are in Chapter 5 covering itemized deductions, still covering the session of itemized deductions. Contributions, we looked at cash contributions, and there's some substantiation limitations on when I make contributions. If they are less than $250, cancel checks will do. $250 to or above, there's going to have to be some type of written acknowledgement from the company or from the charitable organization. Anything $500 and over, there's a form you have to fill out in addition to the written confirmation. $5,000 is going to require you to have a appraisal. And so then we looked at contributions of property. Generally, when you contribute property, you can get a deduction equal to the fair market value of the property. That's the general rule. When the property would have been sold for ordinary income or short-term capital gain, instead of me contributing, had I sold it and I would have gotten ordinary income or short-term capital gain, then my deduction is going to be the fair market value minus ordinary income or the short-term capital gain. If the property that I sold would have yielded long-term capital gain on the sale, then generally for the deduction I can get the fair market value. If it would have been donated to certain organizations, and they list those organizations, or donated to an organization and it wasn't used for its intended purpose, like donating artwork to a museum, that's its intended purpose. Donating artwork to a university to hang in the president's office is not. So if it's a situation that it's donated in that manner, then you would have to take, your deduction would be the fair market value minus the long-term capital gain. Okay, so we picked up, I want to start at the percentage limitations that appear at the bottom of page 512. These limitations gets confusing. So basically the way I like to go over them is I will read that passage in the textbook and then we will make a few notes on that. So starting at the bottom of page 512 under percentage limitations, this is generally a taxpayer may not deduct total contributions in excess of 50% of the taxpayer's adjusted gross income. So on our handout we wrote deductions basically are going to be 50% of AGI. That's my general rule. And this is for donations that are made to, as the book says, this 50% limitation applies to donations to all public charities and all private operating foundations and private non-operating foundations if they distribute their contributions to public charities within a specified period. So that works for those. Now, gifts to other qualified organizations, such as certain private non-operating foundations, fraternal societies, and veteran organizations, as well as gifts for the use of an organization, are going to be limited to 30%. So basically donations to private non-operating foundations, and they listed some other ones, fraternals, and also for the use of the organization. So if it's for the organization to use. Okay, in that case, it's going to be limited to 30%. It's going to be limited to 30% of their AGI. Okay, they go on to say special rules apply to contributions of long-term capital gain property. Okay, so it's long-term capital gain property. If the full fair market value of a gift of long-term capital gain property is deducted and the contribution is to a 50% organization, the contribution is subject to the 30% limit. So under my 30% limit, I have contributions made to those particular foundations and for those that are using it within the organization. And in addition, that's going to be limited to 30% of the AGI is fair market value long-term capital gain property that's given to a 50% organization. Okay, so we have long-term capital gain property that would have yielded long-term capital gain property that's given to a 50% organization, which is public or private charities or organization. In this case, the deduction is going to be limited to 30% of the AGI. So let's look at that again. It says special rules apply to contributions of long-term capital gain property. So contributions of long-term capital gain property. If the full fair market value of a gift of long-term capital gain property is deducted and the contribution is to a 50% organization, then that contribution is going to be subject to the 30% limit. So it's going to be subject to the 30% limit. It goes on to say, now taxpayers may avoid this 30% limit on contributions of long-term capital gain property by electing to reduce the value of the property by the appreciation that would have otherwise been long-term capital gain, in which case then the 50% applies. So you're thinking, what are they referring to? They're saying that if we have this property here that is fair market value, long-term capital gain, meaning I contributed property and I'm going to get a deduction of fair market value in its long-term capital gain, and I made that contribution to a 50% organization. They're saying this amount of my deduction is going to be limited to 30% of my AGI. Okay? They said now you can elect out of that. Now you can elect out of the 30% and get the 50% limit to the AGI if this is only allowed if you reduce the value by the appreciation of the property. So if you reduce the value by the appreciation of the property. So you're thinking, okay, still, what does that mean? And actually, they have a pretty good example of it at the top of page 5-13. The first example, we have Carol donates publicly traded stock worth $15,000 to a qualified 50% charity. The original purchase price of the stock 10 years ago. So because long-term capital gain, I held it for more than a year. So she had it for 10 years. So if she would have sold it, it would have yielded long-term capital gain. So she has this publicly traded stock worth $15,000. She gave it to a 50%, a qualified 50% charity. The original stock price 10 years ago was $10,000. It was $10,000. Because the stock is a gift of long-term capital gain property, Carol's deduction is limited to 30% of her adjusted gross income. Given that Carol's adjusted gross income is $20,000, she may take a deduction of $6,000. So given that, and I'm visual, so let's kind of write this down. Let's deal with what's going on in the example. I think it's important to see. We're looking at the example that's on page 5-13. We're looking at that first example. She donated stock. $15,000 was the fair market value at the time of the sale. She originally paid $10,000 for it. That was her original cost. So she has a $5,000, and it would be a long-term capital gain. She has a $5,000 long-term capital gain. This stock would be limited to 30% of her AGI. That would fall into 30% of her AGI. Carol's AGI is $20,000. Okay? So 30% of her AGI is $6,000. Okay? So she would be limited to a $6,000 deduction. Okay. So given that Carol's AGI is $20,000, she may take a deduction of $6,000, 30% of her AGI, and may carry the remaining $9,000 over. So what they're saying is that she has long-term capital gain, but she's going to get a deduction. She can get a deduction of the $15,000. She can get a deduction of the $15,000. And so it's going to be limited to 30% of her AGI. So she can take $6,000 and the remaining $9,000 will be carried forward. So let's keep looking at the example. It says, given that Carol's AGI is $20,000, she may take a deduction of $6,000 and may carry the remaining $9,000 forward to the following year. Now she can elect, okay, because remember it's limited to 30% of her AGI. Alternatively, Carol may deduct the original $10,000 cost of the stock using the 50% AGI rule, which would give her a $10,000 deduction in the current year. Even though she would have a larger deduction in the current year, she would lose the $5,000. So you're like, okay, what do we mean? Okay, so let's look at what happens. She can make an election to have it limited to 50% of her AGI in the current year, which in this case would be $10,000. If she takes the fair market value of $15,000 and reduce it by the appreciation of the property. The appreciation is basically the growth, in this case, $5,000. Okay, so that means in the current year, 2008, in that example, she would get a $10,000 deduction. She would get a $10,000 deduction. Now, she can get that, and that's all she would get, but she would be able to get the full deduction this year. Under the 30% rule, she would get $6,000 in 2008, because that's all she would be able to get, but the remaining $9,000 could be carried forward. So here she gets a total of $15,000 deduction, but she's only going to be able to get $6,000 this year. The rest she has to take in a later year. And in this one, she gets a $10,000 deduction this year, and that's it. So it's kind of up to her how she wants to do it, because it's an election that is made. It's an election that's made on whether to go ahead and take the immediate $10,000 deduction, or whether she wants to take the $6,000 and then carry the other $9,000 forward. Okay, so that is the way that works. So if we look at it again, we have a donation of fair market value property, long-term capital gain property, and if it's given to a 50% organization, we're going to be limited to 30% of our AGI. We can elect out of that, but in order to do that, to be allowed, we have to reduce the value by the appreciation. Okay, now we're still reading at the top of page 5-13. It says taxpayers, taxpayers may avoid the 30% limit on contributions of long-term capital gain property by electing to reduce the value of the property by the appreciation, in which we did, and in that case they would get the 50% limitation. They would get the 50% limitation. Now our last one, 20%, long-term capital gain property donated to other than a 50% organization is subject to a 20% adjusted gross income limitation. So if I have a property that's fair market long-term capital gain property, okay, that's given to not a 50% organization, but any other organization, is going to be limited to 20% of the AGI. So a long-term capital gain property given to 50% organizations are going to be limited to 30%, or you can elect out of it and limit it to 50%. Now, if I have long-term capital gain property given to to an organization other than a 50%, then it's going to be limited to 20% of my AGI. Now, all these deductions, be it 50%, 30%, 20%, is going to be allowed only to the extent they do not exceed the 50% AGI limit. Bottom line, they're saying you can't take more than 50% of your AGI. That's pretty much in contributions. Now, they may be a combination of some that were limited to 30, some that were limited to 20, but you can't take more than 50. And the example that we want to look at is the example. There's another example on page 5-13. Let's look at that. In March of 2008, Grace contributes $15,000 in cash to a public university. In addition, at the same time, she donates $7,000 cash to an organization subject to 30% of AGI limitation. Grace had adjusted gross income in 2008 of $35,000. Okay, so basically her AGI is $35,000 times 50% equals $17,500. So bottom line, all these deductions that we take can't be more than $17,500. So she contributes $15,000 in cash to a public university. So that is basically a 50% limitation contribution. So she can get, she donated $15,000, so she gets the full $15,000 because it's not more than 50% of her AGI and it's not more than my overall limit. So she gets to take the full $15,000 deduction that falls under the 50% limitation rules. Then she had $7,000 in cash that she donated to an organization that was subject to 30% of her AGI. That was subject to 30% of her AGI. So the way that one works is that we're going to look at 30% of her AGI, 35,000 times 30% of her AGI. Let's see, 35,000, 30%, 10,500. And then we're going to look at the actual contribution, which was 7,000. We're going to look at 7,000. Okay. So she gets to take basically the lesser of those two. Okay. It's limited to 30% of her AGI, but the deduction was only 7,000. So she's going to get the full deduction. Okay. So 7,000 would be the full deduction. The issue is that if she takes the 7,000, that full 7,000, that means she would end up with a $22,000 charitable contribution deduction. She can't take more than $17,500. So therefore, she's going to only be able to take in this year $2,500, which would bring her charitable contribution up to $17,500. The remaining amount has to be carried forward to the next year. So that difference that she cannot take has to be carried forward to the $4,500 has to be carried forward. The excess is carried forward, and she has 5 years in which to deduct that, the excesses. So the total amount can never be over 50% of the AGI. Okay, we're going to do 2 self-studies. Okay, there is one first on page 5-15. Let's look at that one first. We're going to do a number of problems too. Self-study 5-4. During 2008, I'm on page 515. During 2008, Eric gave $260 to his church for which he received written acknowledgement. So he can make that deduction. He's got written acknowledgement for that. He also gave and has receipts for $75 given to the Boy Scouts of America. So that's okay. He can take that. And $125 given to the Mexican Red Cross. Okay, Mexican Red Cross can't take that because of international or it's not U.S. Eric gave the Salvation Army old clothes worth $150. The original cost was $1,700. He can take the worth price of $150. And then last year, Eric had a large contribution and could not deduct $800 of it due to the 50% limitation. So This year he has AGI of $21,325, so he has plenty. So he can take the $260 given to his church because he has written acknowledgement. He can take the $75 given to the Boy Scouts of America, and then he can take the $150 for his clothing contribution, and then he can take the $800 for the carryover from last year. So those are the amounts that he can take. Okay, let's look at on page 541, I believe, problems 14 and 15, which both have to do with charity. So let's look at that one. Charitable contributions. Okay, number 14. Barbara donates a painting. Oh, we did that one. Okay, let's do 15. Sorry about that. 15. Jerry made the following contribution in 2008 to the synagogue by check, so he can take that. And then to the Republican Party by check. We can't make political contributions, they're not deductible. The American Red Cross, he can take that, the $150. And then his lodge had a holiday party. He can't take that. So his total contribution would be $830 based off of that information. In addition, Jerry donated used furniture to the Salvation Army costing $2,000 with a fair market value of $400. So he can take the $400 fair market value. Okay? Assuming Jerry has adjusted gross income of $45,000, what would he be able to take? So he would be able to take the $830 plus the $400 of furniture. Okay, pretty simple, that one. Let's look at 16. Richard donates publicly traded Microsoft stock with a basis of $1,000 and a fair market value of $15,000. So we have the stock. Right now the fair market value is $15,000, and we had a cost or a basis of $1,000. And so we have appreciation or long-term capital gain of $14,000 on that stock that we contributed. Okay, so which is she donates it to a college he attended, which is considered a public charity. How is the contribution treated for Richard purposes? Okay, and did they give us his AGI? They don't tell us his AGI. Okay. This is going to be property, fair market value contributed property that's going to be subject to 30% of his AGI limitation. So it doesn't tell us what his AGI is, but it just depends. So it's initially going to be subject to 30% of his AGI. Now he can elect out of that. So if he go ahead and let it be limited to 30% of his AGI, he gets the $15,000 deduction. Either he's going to get it all in 1 year or may have to be split. If he elects, okay, out of that to where he takes the $15,000 minus the appreciation, he would get $1,000 deduction that's going to be subject or limited to 50% of his AGI. So he loses $14,000 by wanting it to be under the 50% AGI limitation. So in this instance, it wouldn't be worth it. We would want to keep it at 30%. And even if we have to spread that $15,000 over 1 or 2 years, it would be a bigger benefit to us because in that case, we end up losing $14,000 of our deduction. We end up losing $14,000 of our deduction. Okay, so that is contributions. There's a lot in contributions. Take your time, read through it. Just know there's a number of limitations and a number of things that we have to consider when we're looking at contributions. So just make sure you're aware of that. Okay, so let's look back at our Schedule A and continue to look at all those things we listed or looked at are here on our Schedule A, and I just kind of want to blow that up for you a little bit so you can see where we would put these items that we just looked at. Gifts by cash or check if made any gift of $250 or more would be line 16 here. Other than cash or check of any gift of $250 or more with 17. So that's our clothing and our other things that we donate. Other than cash or check, $250 or more, we need to fill out some information. You must attach a form 8283 if it's over 500, where they're going to ask you a lot of detailed information. And then if I had carryover from the previous year, I would report it here on line 18. The next thing we want to look at is casualty or theft losses. And there's a form 4684, which once I go over the rules, we'll look back at that form. But that's the next thing we want to look at is our casualty and theft losses. Okay, so let's look at that and begin to write some notes on our casualty and theft losses. Okay, we want to pick up, let's find the right page in the book. Okay, at the bottom of page 515 is where we want to start. We want to start at the bottom of page 514, where they talk about our casualty and theft losses. Okay, casualty and theft losses. First, we want to look at casualty. What does that mean? We know what theft means, but casualty basically is unusual, they say. Unusual in nature. It's going to be sudden, and it's going to be unexpected. So when we're talking about casualties, we're talking about unusual, sudden, and unexpected. Unusual, sudden, and unexpected. They give some examples here. Examples of casualties include property damage from storms, floods, shipwrecks, fires, automobile accidents, and vandalism. Okay, for damages from weather conditions to be deductible, they tell you the condition must be unusual for that particular region. Okay, so it has to be unusual for that particular reason. So you want to question in a place where there's hurricanes, is it unusual? Okay, so you want to look at that and consider that. To qualify as a casualty, an automobile accident must not be caused by the taxpayer's willful act or willful negligence. So for a car accident to be qualified, it can't be due to the taxpayer's willful acts or negligence. They give an example at the top of page 516. Taxpayer has an automobile that he decides is a lemon, and he wants to get rid of it. He drives the automobile to the top of a cliff, and he pushes it off. This is not a casualty loss since it was an act of will. Okay? It tells us many events do not qualify as casualties, so you want to be careful. For example, progressive deterioration from rust or corrosion and disease or insect damage are usually not sudden enough to qualify. So extreme termite damage, deterioration, it happens over time, so it's not going to meet the sudden rule. So it's got to meet the sudden, it's got to meet the unexpected, and it's got to meet the unusual. For instance, in the case of Katrina, you say, well, they're used to having, hurricane issues there, but not to the magnitude. So it would meet the unusual. It was sudden, and they were expected it, but it wasn't to the magnitude of which they received it. So just keep that in mind. The IRS has held that termite damage is not deductible as a casualty. Okay, so keep that in mind. So keep in mind that what you're looking at. Okay, now these casualty losses are deducted in the year of the loss. So normally they're deductible in the year of the loss, or you can even deduct them in the previous year. And that's only if it's declared a disaster area. Okay, so when they have a disaster and the president comes on and he declares it, or they declare it a disaster area, in that case, if it happened in 2008, I can deduct it on my 2008 tax return, or because they declared it a disaster area, I can go back and amend my 2007 and deduct it on my 2007. The main reason for that is that in the year of the loss, in the year of Katrina, people probably had extreme losses. They had lots of losses. They had, loss of wages. And so their tax return wasn't normal. And so they probably may not have got a good benefit or a benefit from deducting the loss in that year. But let's say when they look at their 2007, wow, we had a good year. My income was high. And so it would be more advantageous for me to take the loss in 2007 than in 2008, the year of the loss. So that's what happens, or that's the option you have when the area is declared a disaster area. Okay. So let's look at the amount of the loss. They have two rules here as we look at and deal with the amount of the loss. And these appear on the bottom of page 516 under measuring the loss, They have a rule A and a rule B there at the bottom. Okay. Basically, the loss is going to be the decrease in the fair market value not to exceed the adjusted basis. Okay, so the deduction under Rule A is going to be the decrease in the fair market value. So when I'm trying to determine what's my deduction, it's going to be the decrease in the fair market value, but I can't exceed the adjusted basis in it. Okay, and so Rule A applies to partial losses or partial losses for business and investment property. Sorry about that. And then for personal, we use this for partial losses. My writing's horrible today. And for when we have a complete loss, meaning when it's totally lost. So we use Rule A for business and investment properties for partial losses. And then for personal property, we're going to use Rule A for partial and complete losses. Okay. Then we have a Rule B. Rule B, the deduction is going to be the adjusted basis. Okay. And that applies to when we have a complete loss of business or investment property. Okay, so it just depends on whether you use Rule A or Rule B. Rule A is going to be used for when you have a partial business or investment property loss, or when you have a personal loss. That's be your personal loss, be a partial loss or complete loss. You're going to use Rule A, where you're going to get the loss is going to be the decrease in fair market value, meaning what my value was before, what it was afterwards, the decrease in fair market value, not to exceed the adjusted basis. Rule B, the deduction or the loss is going to be the adjusted basis in the property, and I'm going to use this only for business investment property complete losses. Okay, let's look at the top of page 5-17. If the taxpayer purchases a house 15 years ago for $25,000, today it is worth $160,000. And heavy rains caused the house to slide into a canyon and be completely destroyed. The taxpayer's casualty loss deduction. So this is personal. It's a complete personal property loss. So the deduction is going to be a decrease in the fair market value. Okay. The decrease in the fair market value was $160,000 before the rains came. After the rains came, 0. So therefore, decrease in fair market value of 160, not to exceed the adjusted basis. So we look here. The taxpayer's casualty loss, then therefore deduction under the rule A is going to be the decrease in the fair market value, but not to exceed the taxpayer's basis. So the deduction for that taxpayer is going to be the $25,000. So even though in the case the market value of the home at the time of the loss was $160,000, so I can't take a loss more than my adjusted basis into the property. Okay, so those are the original deduction rules. You know, what deduction am I going to take? The next thing we want to look at is deduction limitations. There's some deduction limitations. There's 3 that we're going to look at. There's 3. Insurance proceeds. We have a $100 limit, and then we have 10%. Okay, insurance proceeds reduce the amount of the loss. So if you think about it, in that one where we have our $160,000 home, $25,000, if they were insured, then they're going to be covered more than $25,000, so they're not going to end up taking a casualty loss. Now, they may begin to take a loss or something on the contents of the home. So often, I used to be an auditor for the Internal Revenue Service. And things that we would suggest to people, it would be hindsight, of course, is that you take pictures and things in your home, periodically go through and take pictures of your rooms, of pictures on the wall, and so that when you have a complete loss, if your house is burnt down in a fire, it would be difficult for you to remember every little detail, every couch, every sofa, every picture. So if you take pictures of these items periodically, every 6 months or so, put them somewhere obviously besides in the house, then it would help you recall what your true loss was, not just only for the IRS, but also for the insurance company. You would be able to verify those things. So just keep those in mind. So probably likely in that $160,000 home sliding off the cliff, they had insurance enough to cover that. So we're going to take that $25,000 deduction minus the insurance proceeds. So given that, we won't have a deduction. And so the first thing you want to do is deduct the insurance proceeds from that. And then you want to deduct $100 per each casualty. Okay, so if I have more than one casualty, maybe I had a fire, maybe I had a flood, then it's $100 per casualty. And then also it's going to be limited to 10% of the taxpayer's AGI. And this is for personal casualties, not for business casualties. Okay, so that's going to be for personal casualties. And so actually we want to look at the example on page 516. So let's look at the example on page 516. Okay. Make sure I'm looking at the right example. On March 2008, Amy's house is damaged by a flood. Shortly thereafter, that's not the right one, the one on page 517. In 2008, John discovers a theft of personal property which had a fair market value in an adjusted basis of $4,000. So we want to look at the one on 517. We were correct. For that year, his adjusted gross income was $24,000. His casualty loss deduction. So this is getting to the deduction. Okay. So he had a loss, or he gets a deduction. He had a loss, I won't say a deduction, of $4,000 because it was a theft. So if somebody steals it, it's gone. So he had a loss of $4,000. It's first going to be limited or reduced by any insurance proceeds, and they don't mention any insurance proceeds. And then it's going to be reduced by $100. Okay. And then it's going to be limited to 10% of his $24,000 AGI, which is $2,400. So therefore, his casualty loss deduction would be $1,500. His casualty loss deduction would be $1,500. Okay. Right there on page 517, let's also look at self-study 5.5. Vivian Walker, AGI of 25,000, has a personal coin collection acquired 6 years ago that has a fair market value of 9,000 and a basis of 6,000. The coin collection is stolen by a burglar. Vivian's insurance pays her $3,300 for the theft loss. They want you to use forms 4684, casualty and thefts, on page 519. But let's just go through the calculations right now, then I'll actually show you the form. Okay, so we want to start, and this is 5.5 self-study, to where her loss, she had 9,000 was the market value, and her basis was 6,000. Remember, we got to use Rule A. Rule A would be the decrease in the fair market value, which in this case the fair market value was 9,000. So if someone stole it, that decrease would be 9,000, but not to exceed her basis. So therefore the loss is only going to end up being 6,000, which is her basis. She can't get the fair market value. Minus her insurance, she got insurance proceeds of $3,300. And so that leaves us $2,700. And then minus the $100 per casualty. And then her AGI was 25,000. 10% of that is 2,500. So in that instance, the deduction ends up being 100. The deduction loss ends up being 100. Let me see if I can find you that self-study page. Okay. And I don't know if this is going to be clear enough for you to see it, but I'll put it up here for you. See if we can zoom in a little bit so you can see the form. This is form 4684 that is used for casualty and theft losses. Notice it has space for 4 particular ones. And we have our coin collection there. And like I said, you may not be able to read it, but I'll point it out to you. On the first line, it talks about 6,000, cost of the basis, minus the insurance proceeds of $3,300. And then the fair market value before the casualty was 9,000. The fair market value after the casualty was 0. And then, so therefore, I had a drop in fair market value of 9,000. Enter the smaller of line 2, which was the cost or the basis, or line 7, which was the decrease in the fair market value. So therefore, I'm going to have to take the 6. And then subtract line 3 from line 8. So 3 was my insurance proceeds. So I'm going to take 6,000 minus my insurance proceeds, and I get the 2,700. And so then that's my casualty loss or theft loss minus the $100 floor. And then if you get on down, it's minus the 2,500, which is 10% of the AGI, and you get a $100 deduction that would go to that line item on Schedule A that I showed you. That would go to that line item on Schedule A that I showed you. Okay. That is casualty and theft losses. That's casualty and theft losses. The next section that we're looking at, let's pull up our Schedule A again. So that in that particular example, that 100 would go right here. So before you carry it to the Schedule A, you would end up doing all the limits, and then the 100 for that particular would go right here on line 20. Okay. Next, we want to look at miscellaneous. Here we have job expenses and certain miscellaneous deductions. So we want to look at what's included in here and what can I take there as miscellaneous deductions. Okay. Our miscellaneous deductions are going to be, we have 2 types of miscellaneous deductions that we want to look at. We have a type that is going to be limited to 2% of AGI limitation. So we have some that are going to be limited to 2% of our AGI. And then we have some that have no limit. So we have 2 that we're going to look at. 2% of our AGI. Okay. We have our unreimbursed. employee business expenses. So as an employee, if I incur expenses on behalf of my employer, then those are considered unreimbursed employee business expenses. As long as they're deductible business expenses, my employer doesn't reimburse me, then I can deduct them on Schedule A as a miscellaneous deduction, but they're going to be limited to 2% of my AGI. Okay? And then we have employee business expenses that are reimbursed from a non-accountable plan. And what we mean here is that we have situations, and I'll briefly explain this. We have an accountable plan versus a non, and I think we've talked about that. But an accountable plan is when I incur expenses by my employer, they reimburse me. I have to account for those expenses. I have to give an accounting to them and give back any excess. So I have to be accountable for that. A non-accountable a plan would be if I have to incur some expenses, they give me, let's say, a $2,000 check, a $2,000 budget, and they say, okay, this should be enough to cover it. I don't have to account back for it. I don't have to return any excess. It's non-accountable. They just give it to me. I incur the expense. If there's any excess, I don't have to account to them what I did with it. So that's accountable versus non-accountable. So in this case, reimbursements from a non-accountable plan would be subject to 2% of my AGI. The miscellaneous section is the last section of Schedule A deductions we're going to cover, but there's some other items in this book that we will cover that have to do with, this chapter that we have to deal with educational incentives. So continue to read Chapter 5, and we will be able to complete Chapter 5 in our next session. So that's it.